All right, let's dive in. We're going to talk about why the stock market feels so weird right now. You know that feeling that the old rules just don't seem to apply anymore? Well, you're not wrong. We're going to look at the symptoms, figure out the diagnosis, and see what history tells us might be just around the corner.
I mean, this is the big question on everyone's mind, right? For what felt like a long time, the market was pretty smooth sailing. But now, the waters are getting really choppy. That easygoing confidence has been replaced by this constant feeling of, well, uncertainty. So what is really going on under the surface?
Okay, so let's approach this like a doctor trying to figure out a patient. The first thing you do is look at the symptoms, and it's become crystal clear that we've shifted gears, big time. We've gone from what felt like a pretty easy sprint to a grueling, totally unpredictable marathon.
Just think back a year or two ago. From 2022 to 2025, it was basically an everything goes up kind of market. I mean, the S&P 500 had 3 straight years of double-digit gains. It was honestly hard to lose money. But now in 2026, yeah, that party is over. The whole game has changed. Now, the market's gains are being pulled up by just a tiny handful of stocks, and that's creating this huge split between the winners and everybody else.
So we've seen the symptoms. What's the official diagnosis for this whole condition? It really helps to give this market a name so we can understand the playbook. And here it is. The diagnosis is a late cycle bull market. This isn't the beginning of the party, it's more like the after party, where things start to get a little weird and complicated. Growth is slowing down, inflation is just sticking around, and only a few big names are keeping the market propped up. So yeah, it's still technically a bull market, but it's an older, much more tired, and cautious one.
In the characteristics of this phase, they're super specific. You've got economic growth that's cooling off, but it's not crashing. You have inflation that just won't go away, which keeps everyone on edge. Nobody knows what the Fed is going to do next, which creates all this uncertainty. And like we said, with the gains all piled into a few areas, the whole market is just way more vulnerable to those sudden, sharp pullbacks.
So we've got our diagnosis. But why is this happening? Let's dig into the 4 key causes, the actual forces driving this market's strange behavior.
First up is this constant tug of war between interest rates and inflation. See, after some rate cuts back in 2025, the market got kind of greedy and started expecting even more. But with inflation stubbornly stuck around 2.5%, all that certainty just vanished. And now you've got rising bond yields putting some serious pressure on stock prices. It's a really delicate balancing act.
The second cause? External shocks. And these aren't some far-off possibility, they are happening right now. You see headlines just like this one from Reuters showing a direct link between a conflict overseas and how the market reacts. Oil prices jump, and that immediately gets people worried about inflation again.
And this creates a ripple effect. Just look at this from Axios. These same tensions are causing borrowing costs to surge. That makes it more expensive for companies to borrow, for people to get loans. It's another brake on the economy.
And the impact on investor confidence? It's been pretty severe. The combination of all these shocks recently pushed the market to a 6-month low and even knocked the tech-heavy NASDAQ into a correction. That's a drop of 10% or more.
And the final cause is this massive divide in performance. It's not one big market anymore. You've got energy and industrials doing really well, partly because of those geopolitical tensions we just talked about. And of course, AI is still this huge long-term driver for tech. But then you have sectors that are really sensitive to interest rates, like financials and consumer discretionary, and they are lagging way, way behind. This is probably the clearest sign you can get that the broad, easy money rallies are over.
Okay, so with the diagnosis and causes laid out, what's the prognosis? Where could we be headed? Let's look at 3 possible futures for the market over the next year or two. All right, scenario 1, the best case, is the famous soft landing. This is where inflation finally chills out, growth keeps chugging along, and more sectors get to join the party with some moderate gains. The messy middle ground is what you could call stagflation light. Inflation stays annoyingly high, growth slows, and you get a flat, choppy market where picking the right sector is everything. And then, the worst-case scenario is a full-blown recession where people stop spending and we face a really serious market downturn.
Now, while this whole environment feels really unique to us right now, believe it or not, we have seen patterns like this before. Looking back at the market's past medical history, if you will, gives us some amazing context for what we're seeing today.
The late 1990s is such a classic parallel. Just like today, the market was completely dominated by a tiny group of huge tech stocks that everyone was piling into. And the lesson from the dot-com crash that came next is pretty clear. When markets get this narrow, they become really fragile and can reverse
hard and fast. And then there's the 1970s. The similarities here are honestly kind of uncanny. You had geopolitical shocks causing oil prices to soar and inflation that was high and persistent. The lesson from that decade is a bit of a sobering one. That combination of high inflation and slow growth is one of the absolute toughest environments for stocks to succeed in.
You see, all these historical examples, they fit into this classic cycle. It starts with easy money and stimulus, which then fuels a big bull market. That eventually leads to overvaluation, and then a shock hits. Either inflation gets out of control or some external event happens. So the central bank steps in and tightens policy to fight it, and that leads directly to volatility and, often, a correction. Right now, we're living somewhere between stages 3 and 5, navigating the absolute trickiest part of the whole cycle.
So, let's put it all together. What's the wellness plan for an investor in this kind of market? Really, it all comes down to balancing the key risks against the potential opportunities. This is the battleground for investors right now. On one side, you have some pretty significant risks: interest rates staying high, corporate earnings slowing down, and geopolitical conflicts. But on the other side, there are still some powerful opportunities. The long-term AI revolution is not going away, and there's new life in sectors people had forgotten about, like energy and industrials. And it all points to one thing. This is a true stock picker's market, where being careful and selective is more important than ever. And that brings us to this final question. It seems like the era of a rising tide lifting all boats is over, at least for now. Success in this late-cycle world isn't about just riding the market's general direction anymore. It's about carefully choosing the specific ships that are actually built to get through these choppy waters. The playbook has definitely changed, and being selective is the new name of the game.